Are you a first home buyer and unsure of where to put your money to get the biggest gains in 2024? The Fast 50 is a valuable resource for property investors looking to make informed decisions about their real estate investments. Be the first to get into the next investment hotspots and make your money work harder for you. Get your free copy of the report now by visiting smartpropertyinvestment.com.au.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Hey everyone, welcome to a brand new episode of the Smart Property Investment Show. Grace Ormsby here. As you all know, rates have held on to their 4.10% position for the month of August, thanks to the RBA's latest decision. I was lucky enough to sit down with the chief economist over at Creditor Watch, Annika Thompson, to chat through what it actually means. So I hope you enjoy. Annika, thank you so much for taking the time. How are you today?
Very good, thank you. Thanks for having me.
We've had now a couple of days since the Reserve Bank has made the decision, a little bit of time to settle, work out what's going on. How expectant were you of the rates to remain at 4.10% in August?
Yeah, it was something that I was expecting. I didn't think there was anything in the data that was released over July that gave a huge signal to the RBA that that they still needed to work on getting inflation under control. I think everything that came out sort of indicated to the RBA that what they were doing is working, albeit slowly, and to just probably the best decision was to stay on this trajectory until we get some more data out of the next couple of months.
So can you give us a little bit of insight as to some of those factors that are at play and what has been really influencing the RBA's decision-making at this point in time? Because inflation's obviously been a key figure, but we're also starting to see the employment figures come out and sway that as well.
Yeah, unemployment is really key for the next couple of months, the unemployment rate. So it's still at, near record low levels, still a very strong employment market out there, although there are sort of early warning signs, I guess, that the unemployment rate will rise over the next couple of months. And I think the RBA are very aware of that. They'd be watching things like SEEK's job vacancy data, the ABS job vacancy data, ANZ have a job vacancy index. All these things are showing that the number of jobs being advertised is much lower than this same time last year. So we do know some heat is coming out of the jobs market, even if it's actually not showing up in the unemployment rate. So that's one that's really important for them to watch. Obviously, you mentioned inflation. Goods inflation is heading in the right direction. The rate of increase in, things we buy, food, clothing, footwear, household goods especially, is all coming down. The only issues with inflation now, well, not the only, sorry, but the bigger issues with inflation now are rents, utilities, electricity, gas and the like, and insurance. And those sorts of things you can't really impact through higher interest rates. It's not sort of demand-led issue. It's more supply side factors that are impacting insurance and rents and the like. So I think the RBA are also very aware of that.
Where to then from there, if it's not actually a rate issue for some of those things? Is it just that thing where we have to just wait and see what happens next?
Yeah, well, with rents especially, that's, and I'm sure a lot of, your listeners in the property market will be aware, that's a long-term structural issue. The only thing that is really going to solve that problem is more supply, so more rental properties being made available for the number of tenants that are out there. And that takes a while to happen. I do think there will be some easing in that, but a big backlog of houses under construction that slowed, or the construction timeline slowed right down over COVID. So there's this huge number of houses that are due to finish that probably should have finished in normal times a year ago. So a lot of those people are sitting in rental properties at the moment. They'll eventually move into their completed housing, and that will sort of unlock a little bit of rental supply, but it won't be enough to sort of ease the pressure and get us back onto sort of more stabilized rental increases.
Well, I'm going to ask you at some point in this episode what you do think will happen with rates from here, but we're going to take a quick break because then I want to unpack some of the things that we're seeing in the property market. Don't go away. See you on the other side.
Stop overpaying on your home loan. We understand that managing your finances can be overwhelming, especially as interest rates continue to rise. With access to 70 plus lenders, our team of specialised brokers will find the best rates for your specific needs. Count on us to secure a lower rate swiftly, giving you the confidence you deserve. Book an appointment with one of our experts today to protect your financial well-being and secure your future. Call us now at 02 8866 2444 or visit our website at finny.com.au.
Welcome back to this special conversation with Annika Thompson, the chief economist over at Creditor Watch. And Annika, I have to say, we do love getting your updates every month with what you think might happen with the interest rates. And we do appreciate the insight that you can provide, not only in the property market, but elsewhere in the economy and where those factors are really going to be impacting, whether it's business risk or whether it comes back to the retail trade and what's going on there. But honing in now on the property market, it's obviously a very interesting period in that we're in the middle of winter, but we are now looking towards the end of winter and the spring property market, which is traditionally a very busy time for real estate. And I know a lot of people aren't really sure what to expect over the coming months, given that we have had such a swift increase in rates, and that's very quickly having a flow and impact onto people's mortgages and their ability to pay. And I'm curious, from your position as an economist and looking down on all of this data, where you think it could put the property market heading into that traditionally busy period?
Yeah, I think it'll be a bit of a tale of two markets. You've got the two different buyers. I'm not talking about investor and owner occupier. I'm talking about your cash buyer and your leveraged buyer. So, your cash buyers tend to be, the older, wealthier generation. So there'll be certain pockets of our capital cities that'll be a bit more protected because those people aren't impacted by interest rates. And, they're the more well-to-do areas. The downsizer market will still be quite strong. So those single level, high spec units and apartments might still see pretty good demand because their buyer tends to be a cash buyer. Where there'll be probably a fair bit more pain is those areas where nearly every household has to take on a home loan to buy that property. And that's, your newly established suburbs on the urban fringes, some of the inner ring suburbs that, typically sell a smaller unit to a first home buyer. If anyone has gone for a home loan lately, that the amount of money you have to spend today versus 2 years ago is far, far less. And that has to flow through to house prices at some point. But yeah, that there will be, it won't be pain across the board. I don't think, there are, a surprising number of cash buyers out there. I think PEXA released some really interesting data a few months ago. It's about a third of properties are bought without a mortgage. And I think we often do forget that. And that's probably what's given some resilience to the market, and sort of, a general lack of supply, people not putting their homes on the market, paying sort of a wait and see approach.
Do you think we'll see more supply coming onto the market in spring?
Yeah, look, unfortunately, I do think there will be buyers or sellers out there who bought probably within the last 2 years and who are coming off a fixed rate loan. And the reality is, even if you've got a wage increase and it might be, even a decent 5.5% wage increase, it cannot help you keep up, or you can't keep up with your higher home loan repayments, even on those sort of wage increases. So unfortunately, I do think the sort of more recent buyers will be putting some properties on the market. And, my sort of discussions, I keep my ear to the ground talking to real estate agents out there. They are telling me there is a bit of that around. People have just got a little bit over their heads, and, that stock will be coming onto market in spring.
And I guess it probably is still a better time than it might otherwise be for them to be getting into the market if we do have that little bit of a lack of supply at the moment. We've been talking about it for a couple of years now. The lack of supply has sort of kept a floor on that market. Do you think that will continue to be the case, or will we see things soften even more as some of those homes do need to come on?
Yeah, well, it's been okay at the moment because, as I said, the supply has dropped and sort of met the level of buyer demand out there. I do think that gap is going to widen a little bit come spring, but not excessively. Mm-hmm. I think that for the number of buyers that are out there, there will be a bit more a bit more supply for them and a few more options available to them than there have been over the last 6 months. I still think we'll be, relatively well-balanced supply-demand market, and we're certainly not going to see, waves of supply come on that's really going to have a negative impact on house prices. In Australia, if you can maintain your home loan, that's the first thing everybody does, and they cut back in all other areas of their life. They're spending, they eat out less, they go on less holidays, do all sorts of things before, you have to sell your house or get in the position where you need to sell.
It's a good point to make. So then how widespread will this kind of impact be felt? Is it something that we're seeing across the country? Is it the more expensive markets like Sydney and Melbourne that are going to see these flow through first? Do you have any perspective on that?
Yeah, look, I think the Sydney and Melbourne markets obviously have a much more highly leveraged borrower. Those markets and I'll include Brisbane here as well, and probably Southeast Queensland, Gold Coast, Sunshine Coast. Those markets saw a much bigger increase in their house prices over the COVID period. Whereas, markets like Adelaide are a bit more stable. And, while they do have a leveraged buyer, they're not as over leveraged as some of the buyers or some of the owners in the eastern seaboard. So, yeah, I think those pockets of distress will be more eastern seaboard rather than the Adelaide and Perth markets.
Good to know for a lot of people out there, especially anyone operating in any of those markets. It's like always, isn't it? Every market is its own separate market, but obviously they're going to be all impacted by things as widespread as the RBA making a decision on what to do with rates for the next month. We're going to take another quick break. See you on the other side. Welcome back to this conversation with Annika Thompson, Chief Economist at Creditor Watch. Annika, thank you so much for sharing your insights today. It does feel like we're still in a pretty good position, given that the Reserve Bank, there's probably been a fair bit of criticism leveled at them for the last few months for acting so swiftly in lifting those rates. We all do understand that it needed to happen to curb that inflation, but it was a shock for a lot of people. So even just kind of taking that step back from property, what is your perspective of where Australia sits right now, when it comes to the health of the economy?
Yeah, look, you've got to put it in global context. Australia raised the cash rate along with every other, most other nations around the world. So, what's happening here with monetary policy isn't unique to us. I think the underlying fundamentals, long-term fundamentals of Australia are still some of the best in the world. So that's a positive. So long term, I think we've still got a very strong economy and good positive fundamentals that people can be happy about. I do think, though, the short term, and certainly all the indicators we're seeing at Creditor Watch in our data, point to a lot more business distress over the next year. I think, businesses like consumers have had, probably some cash reserves, good underlying work orders that have kept them busy over the last 12 months. Demand is slowing and quite dramatically in some areas like retail trade, food and beverage, construction. We're going to see slower demand. So that's going to be sort of the next issue for businesses to contend with. And they've obviously been contending with higher prices for a couple of years now, but higher prices is okay as long as your demand is keeping up. But this is the next issue. Demand is going to fall away and they've still got those higher prices to contend with. So we're seeing sort of our risk indicators for businesses in certain sectors and certain areas of Australia sort of starting to flash a bit red. And I do think insolvencies, or the rate of insolvencies, is going to get worse before it gets better. And it really won't get better until the Reserve Bank starts cutting the cash rate.
How far off do you think potential cuts could be? Obviously, crystal ball gazing here. We've got no way we can give educated opinions and guesses, but I won't hold you to any of your thoughts in this space, Annika.
Yeah, don't. It's the number one question I get asked. Look, all things staying on the trajectory that they are today, which we know history tells us they won't, but assume that happens, I think we'll be probably this time next year starting to see interest, the RBA, in a more comfortable position to start cutting the cash rate and getting the economy moving again, because inflation will have to be under control and there will have to be some reason for them to need to stimulate the economy. And I think, by July, August next year, they might have those reasons. obviously a lot can happen between now and then though. So
as we all know,
I will add that caveat
with COVID and the surprises that brought with it. But
yeah.
Do you think we'll see another rate rise by the end of the year? Because that's also something else that's sort of being talked about. NAB obviously is the only Big Four bank at the moment that's coming out and expecting another one to happen. I guess it is definitely a wait and see kind of thing, but is there still potential?
Oh, the only reason I would think there would be is if the unemployment rate, come September, October, when we get the a better idea of what the next quarter's inflation will be like. If the unemployment rate is still at 3.5%, that will get the RBA worried about a wages inflation. So we might see one more. I'm pretty confident, though, that we're going to start seeing some movement in unemployment. As I said earlier in the podcast, that all forward indicators point to sort of more weakness in the labour force. I also think that the new financial year is sort of a reset for a lot of companies. They start reviewing their headcount, reviewing their profit forecast, their cost forecast, revenue, all of that sort of stuff. So I think that will start showing in the unemployment rate. So I'd say with 80% confidence that I think we're at the peak of the monetary policy cycle, but, the unemployment rate keeps surprising me. So I could continue to be surprised, but.
I think everyone that is listening, though, Annika, has just breathed a bit of a sigh of relief to hear that from you that, even if there were rates were to rise one or two more times, we're hitting that peak. And to know that, by the end of next year, things could have pulled back again as well. That's got to be some good news for everyone out there across the country.
Yeah, look, it's both good and bad news. Like I always say, if the RBA is cutting interest rates, it's good, for people that have debt. But what it means is something's going wrong in the economy and there's a reason why they're doing it. So, yeah, it's like everything. There's a balance. There's a yin and a yang in economics. It's why it's called the dismal science. All good news is met with bad news. So, yeah, look, for borrowers, it would be good news. But for the overall economy, it means there will be some issues. So
a bit of a double-edged sword, but
it is. It's always a double-edged sword, unfortunately.
So what's normal then at this point?
Oh, well, yeah, the number one question. Look, I think an equilibrium cash rate, so one where the economy is either growing or shrinking, is roughly a 2.5% cash rate. I think where we were in COVID, 0.1%, that was extraordinarily low. I don't think we'll ever get back to interest rates that low. And if we did, it means something's gone seriously, seriously wrong. We've had some giant economic shock. So it's not something you probably wish again. But I think at 2.5%, that seems to be a sort of, I would say, where market's sort of going along nicely. We're not too hot. We're not too cold.
Well, I mean, the only thing to sort of ask you about before I let you go, Annika, is just around what to expect over the next 12 months. Are signs still looking good given, we do have those unemployment risks and we've got some more concerns coming up in the business environment? Is it still tracking okay? Are you feeling comfortable as an economist at what's going on across the country?
Yeah, look, I'm one of the people that sort of put my support behind the RBA. I think what they've done, they had no choice, first of all. And I think they're managing things quite well. That, they've had 4.1% compared to where we were, 0.1% seems like a huge increase. And it is, but I certainly think it could have been a lot worse. And I like the fact that they've paused and given themselves some time to really assess, the pain that's out there in the economy. I don't think they're lacking feelings, that they are aware that what they do does have real serious impacts on people and human beings. So, yeah, look, I think where we are is as good an outcome as we can get right now. We're still, people are still gainfully employed mostly. You can get a job if you want one. So those are good signs. It's just things are just going to be a little bit harder for households and businesses and consumers just over the next year.
Don't think anyone can doubt that the RBA has not had a difficult job over the last couple of years, and that, I guess, is set to continue. Annika, thank you so much for your time. Really, really appreciated your insights, and I'll have to get you back on at some point because the RBA does continue to make rate calls every month.
Yeah, all for now. It's going to slow down, a few less rate calls soon, but yeah, at the moment, every month.
Thank you so much to everyone for listening along today. We hope you got something out of that episode. Obviously, a very interesting time for the Australian economy. If you have any questions, editor@smartpropertyinvestment.com.au. Like or review us on whatever platform that you do listen to your podcast on. And make sure you're subscribed to our website for all the latest updates. Otherwise, Facebook, Twitter, LinkedIn, and Instagram. See you next time. Bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.